At the close of a fiscal quarter inside Computer Associates International, in its offices on Long Island, sales executives kept the printers running past midnight. Contracts dated the last day of the month were signed in the days that followed, the paper bearing a date that the clock on the wall had already passed. Inside the company, the practice had a name. It was called the 35-day month. Lawyers and former executives later testified that the wall clock and the calendar had been deliberately separated. And the question this episode answers is how a software company turned the simple act of dating a contract into a machine for hitting Wall Street's consensus estimate quarter after quarter, until the gap between the clock and the calendar grew too wide to close. The mechanism at the center of the Computer Associates fraud is revenue recognition. To understand the fraud, you have to understand the rule it broke, and to understand the rule, you have to understand what revenue recognition was supposed to accomplish in the first place. Revenue recognition is the accounting determination of when a company is permitted to record a sale as earned income. It is not the same as cash. It is not the same as signing a contract. It is a specific point in time, defined by accounting standards, at which a transaction is considered complete enough that the resulting revenue can be reported on the income statement. For most of the modern history of American accounting, the governing guidance for software companies was a set of criteria the record refers to repeatedly. Revenue could be recognized only when 4 conditions were met. There had to be persuasive evidence that an arrangement existed. Delivery had to have occurred. The fee had to be fixed or determinable. And collectability had to be probable. Of these 4, the first is the one that matters for this case. Persuasive evidence that an arrangement exists. In practice, for a software license, that means a signed contract, not a contract under negotiation, not a verbal commitment, not a deal the salesperson is confident will close. A signed contract executed by both parties within the reporting period. This is the baseline. A company that closes a license deal on the first day of the new quarter records that revenue in the new quarter. A company that closes it on the last day of the old quarter records it in the old quarter. The line between those two outcomes is a single day, and the entire architecture of the Computer Associates fraud was built on the deliberate erasure of that single day, repeated across thousands of contracts over multiple years. Why does the timing matter so much? Because Computer Associates was a public company, and public companies are valued not on what they earn, but on whether they earn what the market expects them to earn. The relevant number was the consensus analyst estimate. Every quarter, the analysts who covered the stock published their expectations for revenue and earnings per share. The aggregate of those expectations became the number the company was measured against. Beating the number sent the stock up. Missing the number, even by a penny, sent the stock down, sometimes violently. For a company of Computer Associates' size, a single quarter's miss could erase billions in market capitalization in a single trading session. Here is the structural pressure. Software license revenue is lumpy. A large enterprise software deal might be worth tens of millions of dollars, and whether it closes on March 31st or April 2nd is, from a business standpoint, almost meaningless. The customer is the same. The money is the same. The product is the same. But from an accounting standpoint, those two dates fall in different quarters. And from a market standpoint, the difference between hitting the number and missing it could turn on exactly such a deal. So the company faced a problem that every public software company faces in some form. The natural rhythm of when deals actually close does not align with the artificial deadline of the quarter end. Most companies manage this tension by accepting the variance. Some quarters you beat, some quarters you miss. The market understands that revenue is lumpy. Computer Associates chose a different solution. According to the SEC's enforcement record, the company did not accept the variance. It eliminated it. And the instrument it used to eliminate it was the date on the contract. Recall the first revenue recognition criterion. Persuasive evidence that an arrangement exists within the reporting period. If a deal closed 2 days after quarter end, it belonged to the next quarter, unless the contract said it closed before quarter end. The contract date was the evidence, and the contract date was something the company controlled. This is the elegant and dangerous core of the scheme. The company did not invent fictitious customers. It did not, in the central mechanism, book sales that never happened at all. It took real deals with real customers and moved them in time. A deal that genuinely closed in early April was papered with a March 31st date and recorded in the March quarter. The revenue was real. The customer was real. The fraud was the date. Now we move to the architecture. How did this work step by step inside the company? According to the SEC's findings and the criminal record that followed, the practice operated on a regular cadence tied to the quarterly close. The company's fiscal year ended March 31st, which made the March quarter the most consequential and, in the record, the most heavily manipulated. Step 1. As the quarter approached its end, senior management tracked the gap between the revenue and earnings the company had actually booked and the consensus analyst estimate it needed to meet. This was not a casual exercise. The record establishes that the consensus number was treated as a target to be hit, not a forecast to be reported against. If the company was short of the number with days remaining in the quarter, the gap had to be filled. Step 2. The sales organization was directed to close as many deals as possible before the period ended. This in itself is ordinary. Every sales organization pushes to close at quarter end. The deviation came in what happened when the legitimate closings were not enough. Step 3. When the quarter's actual closed deals fell short of the target, the company held the books open past the official end of the quarter. The reporting period, which should have ended at midnight on the last calendar day, was kept open for additional days. During this extension, deals that closed in the new quarter were captured and recorded as though they had closed in the old one. The contracts were dated to fall within the closed period. This is the 35-day month. A calendar month has 30 or 31 days. The company's reporting month, when it needed to be, ran to 35. Step 4. To make the backdated contracts support revenue recognition, the documentation had to be consistent. A contract dated March 31st had to appear to have been signed by both parties on or before March 31st. The SEC's record describes a deliberate process of dating and, in some cases, redating license agreements so the paper would withstand scrutiny. Signature dates, contract dates, and the internal records of when deals closed were aligned to the fiction rather than to the fact. Step 5. The backdated revenue flowed into the quarterly financial statements. The company reported quarterly results that met or beat the consensus estimate. The market responded as expected. The stock held or rose, and the company entered the next quarter. And here is where the structure reveals its true nature. Because the deals captured in the 35-day extension were real deals that genuinely belonged to the next quarter, pulling them into the current quarter did not create new revenue. It borrowed revenue from the future. The April deal recorded in March was an April deal that would no longer be available to count in April, so the next quarter began already short. It began with a hole exactly the size of the deals that had been pulled forward. To fill that hole, the next quarter's close required its own pull forward, and that pull forward had to be at least as large as the previous one, because the company was not merely maintaining revenue, it was reporting growth. Each quarter, the consensus expectation rose. Each quarter, the company had to beat a higher number while starting from a hole left by the prior quarter's borrowing. This is the structural signature of what accountants call a cookie jar in reverse, or more precisely, a pull-forward scheme that compounds. A cookie jar reserve in its classic form is the practice of stashing earnings in good quarters to release in bad ones, smoothing reported results. What Computer Associates ran was the more dangerous variant. It was not storing surplus. It was consuming the future. Every quarter's success was financed by the next quarter's deals, which meant the scheme could never stop. It could only grow. The moment the company tried to close the books on the actual last day of the quarter, it would report a catastrophic shortfall, because the natural revenue of that quarter had already been spent in advance. The scale, according to the SEC, was substantial. The Commission's enforcement record establishes that the company prematurely recognized revenue across multiple quarters, with the improperly recognized amounts reaching into the billions of dollars in the aggregate across the relevant period. In the fiscal year that drew the most enforcement attention, the company reported meeting or exceeding consensus estimates in quarters where, the record establishes, it would have fallen short absent the backdating. The architecture required participation across levels. Salespeople closed and dated the contracts. Sales management directed the timing. Finance personnel processed the revenue. And senior executives, the record establishes, were aware of and directed the practice. This was not a rogue employee. It was a process, embedded in the company's quarterly rhythm, understood internally by a name. When a practice has a name inside an organization, the practice is institutional. Consider what the name itself tells you. The 35-day month was not a euphemism designed to hide the conduct from insiders. It was operational shorthand among the people executing it. They knew the month did not have 35 days. The phrase acknowledged the fiction openly among those running it, while the external documentation maintained the fiction rigorously. That is the structural feature of mature financial fraud. Internally transparent, externally airtight. The people inside do not need to deceive each other. They need to deceive the gatekeepers. Which brings us to the question of the gatekeepers. How did this practice survive across multiple quarters and years? Who was responsible for catching it, and why did the verification chain fail? Start with the auditors. An independent audit is supposed to provide reasonable assurance that financial statements are free of material misstatement. For revenue recognition, an auditor tests a sample of transactions examining the supporting documentation. For a software license, that documentation is the contract, with its signature dates and contract dates. And here, we reach the central problem of the Computer Associates detection failure. The contracts were dated to support the revenue recognition. An auditor examining a contract dated March 31st sees a contract dated March 31st. The audit procedure tests whether the documentation supports the accounting. When the documentation has been deliberately constructed to support the accounting, the procedure confirms the fraud rather than detecting it. The verification chain depends on the assumption that the date on the paper reflects the date of the event. When that assumption is false and falsified consistently, the standard procedures validate the false picture. This is the structural lesson of the case for the audit profession. An audit tests documents against accounting rules. It does not, in its ordinary form, test documents against reality. The signature date is taken as evidence of when the signature occurred. To detect the 35-day month, an auditor would have had to determine, independently of the contract itself, when each deal actually closed. That would require evidence outside the document. Shipping records, customer confirmations of the actual signing date, internal sales tracking systems that recorded real close dates before the paper was dated, email and electronic timestamps showing when contracts were actually executed. Some of this evidence existed inside the company. The SEC's record makes clear that there were internal records reflecting the true timing of deals, but those records were not the records presented to auditors as the basis for revenue. The presented basis was the dated contract, and the dated contract was clean. What would have had to be true for earlier detection? 3 things structurally. First, the auditors would have needed to identify the quarter end as a zone of elevated risk and to test the timing of transactions near the boundary with heightened skepticism. A cluster of large deals all dated on the final day or two of every quarter is itself a pattern. A company whose deals reliably close exactly when the quarter needs them to is exhibiting a statistical signature that does not occur naturally. Revenue that arrives precisely on schedule, quarter after quarter, against a number set externally by analysts, is not the behavior of an organic sales pipeline. It is the behavior of a managed one. Second, the verification would have had to extend beyond the document to independent corroboration of timing, confirming with customers not whether the deal happened, but when it was signed. The standard confirmation process asks customers to verify the existence and terms of an arrangement. It does not always probe the date with precision, and a customer, indifferent to whether the deal closed March 31st or April 10, might confirm the existence of an agreement dated March 31st without ever focusing on whether that date was accurate. Third, someone would have had to compare the contract dates against the company's own internal sales records, the systems that tracked when deals actually closed before the paper was generated. The discrepancy between those systems and the contract dates was the fraud, recorded inside the company's own data. Now consider the analysts. The equity analyst who covered Computer Associates produced the consensus estimate the company was straining to hit. Their function was to model the business and assess its results. But analysts work from reported financials and management guidance. They do not audit. They do not examine contracts. An analyst sees that the company hit the number again and updates the model. The reliability of hitting the number, which to a forensic eye is a warning sign, reads to an analyst as a sign of a well-run, predictable business. Predictability is rewarded. The market assigns a premium to companies that hit their numbers consistently. The very consistency that should have raised suspicion instead raised the multiple. This is a structural perversity worth stating plainly. The market rewards exactly the behavior that fraud produces. A company that beats estimates every quarter is valued more highly than one whose results fluctuate honestly. The pressure to deliver smooth, predictable, always on target results is created by the market's own preference. The 35-day month was the company's answer to a demand the market itself generated. Then there is the board and the internal controls. A company's internal controls are supposed to ensure that transactions are recorded in the correct period. The control that should have caught the 35-day month is a cut-off control, a procedure ensuring that the books close on the actual last day and that transactions are recorded in the period in which they occur. When the people responsible for the cut-off are the same people directing the extension of the period, the control does not exist in any meaningful sense. A control administered by those it is meant to constrain is not a control. It is a formality. The record establishes that the practice was directed from senior levels. When senior management directs the manipulation, the entire internal control structure is compromised because internal controls assume that management is the enforcer of controls, not the party circumventing them. This is the override problem, and it is the hardest problem in all of fraud detection. Controls are designed to catch errors and lower-level misconduct. They are not designed to catch the people who design and operate the controls. Against management override, the only external check is the independent audit, and the independent audit, as we have seen, tested documents that had been constructed to pass. So the verification chain failed at every link, but not randomly. It failed for a coherent structural reason. Every gatekeeper in the chain relied on the contract date as the anchor of truth, and the contract date was the precise thing the fraud controlled. The auditors tested the date. The customers confirmed agreements bearing the date. The analysts modeled results built on the date. The internal controls that should have governed the date were operated by the people falsifying it. When a single data point is both the foundation of all verification and the object of the manipulation, the entire structure rests on a number the perpetrators are writing. Now, the unraveling. How did a scheme this internally consistent come apart? The exposure of computer associates did not come primarily from the auditors discovering the backdating in the course of an ordinary audit. It came, as such cases frequently do, from a government investigation that reached behind the documents to the people who created them. In the early 2000s, federal authorities and the SEC began examining the company's revenue recognition practices. The investigation reached the conduct around the fiscal year ending in 2000 and surrounding periods. And here the structure of the fraud, which had protected it for so long, became the instrument of its collapse. Recall that the documents were clean. The contracts bore consistent dates. An investigation that examined only the documents would have found, as the auditors had found, paper that supported the accounting. But a criminal and regulatory investigation does not examine only documents. It examines people. It compels testimony. And the 35-day month had a fatal vulnerability that no document could conceal. It was known by name to many people inside the company. When investigators interviewed the participants, the practice that had been internally transparent became externally visible. People who had executed the backdating described it. The record establishes that multiple executives ultimately admitted to the conduct. The internal name, the 35-day month, surfaced as evidence of intent. A practice with a name is a practice that participants understood as a system. That understanding is the element that distinguishes a clerical error from a knowing scheme. The name itself established that the dating was deliberate. The company's initial response, the record establishes, compounded the legal exposure. During the period of the government investigation, individuals associated with the company engaged in conduct that obstructed the inquiry. The SEC's enforcement record and the related criminal proceedings established that there were efforts to mislead investigators about the backdating practice. This is a recurring structural feature in the collapse of financial frauds. The original misconduct, the revenue manipulation, is frequently overtaken in legal severity by the obstruction that follows. The cover-up creates a second, cleaner crime, one that does not depend on passing complex accounting standards. Lying to investigators is straightforward to prove and straightforward to punish. The resolution unfolded across both regulatory and criminal channels. The SEC brought enforcement actions. The Department of Justice pursued criminal charges. The company entered into a deferred prosecution arrangement and agreed to substantial penalties and restitution to shareholders. The record establishes that the company agreed to pay hundreds of millions of dollars in restitution to compensate shareholders harmed by the inflated results, and that it accepted the appointment of an independent examiner to oversee reforms of its accounting and governance practices. Several senior executives faced individual consequences. The record establishes that the company's former chief executive was charged in connection with the scheme and the obstruction that followed, pleaded guilty, and was sentenced to a term of imprisonment. Other executives also pleaded guilty to charges arising from the revenue recognition practices and the subsequent efforts to obstruct the investigation. These are matters of completed criminal record, established by guilty pleas and judgments. Watch the mechanism of the collapse in structural terms. The fraud was sustainable as long as two conditions held. First, the documents had to remain consistent. Second, the future quarters had to keep supplying deals to pull forward. Both conditions failed, but the document condition failed not because the documents were examined more carefully. It failed because the people who knew the documents were false were compelled to speak. This is the structural lesson of detection for a fraud built on falsified documentation. You cannot, in general, detect a consistently falsified document by examining the document. The document is internally perfect. You detect it by reaching the gap between the document and reality, and that gap lives in two places. It lives in the independent records of what actually happened, the shipping logs, the timestamps, the internal sales systems. And it lives in the memories of the people who created the false document. A document fraud is broken by going around the document, either to the independent record of the underlying event or to the witnesses who know the document is false. The compounding structure also guaranteed that the fraud could not simply be wound down quietly. There was no graceful exit. A company running a pull-forward scheme cannot stop in a good quarter because every quarter began in a hole. To stop, it would have had to absorb in a single quarter the accumulated shortfall of every deal it had ever borrowed forward and report a collapse in revenue that would itself invite the scrutiny it was avoiding. The scheme was a treadmill that only ran faster. The only ways off were to keep running until exposed, or to be stopped from outside. Computer Associates was stopped from outside. What does the Computer Associates case establish, structurally, about the mechanism of revenue recognition fraud? First, it establishes that the most dangerous revenue frauds are not the ones that invent fictitious sales. The fictitious sale is comparatively easy to detect because there is no customer, no delivery, no underlying reality to confirm. The timing fraud is harder because everything is real except the date. The customer exists, the product was delivered, the money was eventually collected, only the period is wrong. A fraud built on real transactions in the wrong period passes every test that confirms the transaction is real because the transaction is real. The single false element is the one most gatekeepers take as given. Second, it establishes that the contract date, treated throughout the verification chain as the anchor of truth, is in fact a representation made by management and a representation that management controls. Any verification system that treats a management-controlled data point as objective fact has a structural blind spot exactly the size of that data point. Third, it establishes the compounding nature of pull-forward schemes. Borrowing revenue from the future is not a one-time distortion. It is a debt that must be repaid by borrowing more, growing with each period until the borrowing exceeds the available future. This is why such schemes do not stabilize. They accelerate until they break. In the years following the case, the regulatory and accounting response addressed several of these structural features. The broader reforms of the period, including the Sarbanes-Oxley Act, imposed requirements that bear directly on the failures this case exposed. Executive certification of financial statements assigned personal legal responsibility for reported results to the senior officers, removing the distance between the people directing the numbers and accountability for them. Requirements for the assessment and attestation of internal controls over financial reporting address the cut-off and period recognition controls that the 35-day month had circumvented. And the strengthening of audit independence and oversight, including the creation of a new public oversight body for the audit profession, responded to the structural reliance on auditors who tested documents that had been built to pass. Revenue recognition standards themselves continued to evolve in the direction of greater specificity about when revenue is earned, narrowing the discretion available at the period boundary. The objective of these changes was structural: to reduce the space in which the date on a contract could be separated from the date of the event, and to multiply the points at which that separation could be detected. The Computer Associates case is, in the end, a case about a single day, the day on which a contract is signed, and whether the paper agrees with the calendar. The company found that this day was something it could write, and that the entire apparatus of financial verification would accept what it wrote. The fraud was not in the deals. The deals were genuine. The fraud was in the proposition that a month could have 35 days, sustained as long as no one with the power to compel the truth asked the people who had named the practice what the name meant. When that question was finally asked, the answer had already been given years earlier by the people who had separated the wall clock from the calendar and given the gap a name.